Insights Over Coffee, the podcast where we break down the world of finance, markets, and macroeconomics one conversation at a time. I'm your host, Sahhar Saleh, and joining me today is our CEO at LGIP, Gunnar Turkmen. But before we dive in, a quick disclaimer. This podcast is for informational purposes only. Nothing discussed should be considered financial or investment advice. Always consult a licensed financial advisor before making any investment decisions. Today's episode is all about hedge funds, a term that sounds exclusive, maybe even a little intimidating. For years, hedge funds were seen as the peak of smart investing. It's flexible, powerful, and even built to thrive in any markets. But lately, their popularity seems to be fading. Some say they're outdated, overpriced, or outperformed. Others urge that they still play a vital role in sophisticated portfolio strategies. So what's the truth? A lot of people hear hedge fund and picture something mysterious or risky. In your own words, how would you explain what a hedge fund is to someone new to finance?
Thanks, Sahar. Good morning. I guess it's a good idea to go back and look at the history of how it all started. Not sure of the exact dates, but I think it goes back to the 1950s, where certain investors wanted to own certain equities but didn't want to carry the risk of the market. So what they found was that if you bought a certain stock and you shorted another stock against it, you could have the outperformance of that one stock and also not necessarily be exposed to the market. So that's kind of how the word hedge fund started, because the position was hedged with another. And if the stock pick was correct, then there would be a return that was achieved regardless of market direction. And probably the core underlying objective of any liquid alternative needs to be to provide a return regardless of market direction.
So, was it then considered safe?
I wouldn't necessarily use the word safe. I believe that's derivative that people took out of it. Any investment has to be judged on its own merit. So it was different because it took the market exposure component out of the investment. However, if you're long lost money and you're short also lost money, you could actually lose more money than the market is. So the idea was, it was not for it to be safe, but the idea was for you to be able to purchase stocks that you thought were of good value, even though you didn't believe that the market was going to go up. So that was the inception.
A misconception that I found was that people thought hedge funds were created first, followed by mutual funds. But in 1924, the first mutual fund was created in the United States, followed in 1949, the first hedge fund was created in the United States. Now, why were hedge funds once considered the Ferraris of finance? Was it just performance or something more?
Hedge funds on their own were kind of seen as more complicated because the strategies were not as straightforward as just buying and holding stocks. Some hedge funds, some liquid alternative strategies carry a lot of leverage, so you can have substantial amount of risk in a liquid alternative strategy. However, the core initial purpose of it was to provide a return regardless of market direction.
I think I get it. Being seen as mysterious and private gave them a certain appeal, along with the idea that they aimed to deliver returns regardless of market conditions. Hedge funds rarely use long-term buy and hold strategies, so why might relying on long-term buy and hold strategies be considered risky?
Now that's kind of interesting because if we look at just real assets, if we look at equity assets, if you buy and hold equities for the super long term, you'll do just fine. You'll cover inflation. Very often you'll beat inflation. If you buy and hold gold and assets like that or real estate, this also holds true. So if your investment time horizon is very, very long, then you're actually fine. However, it's very important to understand this very, very long concept. So if you happen to buy equities in 1929, at the peak of 1929, before the crash and the Great Depression, it was going to take you about 25 years for you just to get your money back.
Wow.
So the majority of, talking outside of institutional investors, if you look at private investors, the majority of wealth is accumulated in one's 40s, 50s, even 60s. If you add 25 years to that, it's a long time. So there's that factor that we have to factor in.
Mm-hmm. I guess also because hedge funds typically need to outperform benchmarks regardless of market conditions, not just ride the market. And many investors in hedge funds expect active risk management and hedged exposure, but pure buy and hold doesn't hedge downside risk. How do long-term market cycles influence investors' behavior and portfolio decisions?
When you look at the long term, you can see these very large cycles, and those very large cycles make portfolios gravitate towards certain assets. Because if something lasts for a very long time, then we start to believe that it's going to last forever. It's always only a cycle, because that's just how the universe works, and that's how humanity works. Everything functions in a variety of cycles. So when stocks go up for a very long time, we think that they're always going to continue to go up. When hedge funds do very well for a very long time, we think that they're going to do very well forever. When real estate goes up for a very long time, we think that real estate can never go down. But in reality, these are very, very long cycles. And they're so long that very often we don't realize that they're cycles.
What was the hedge fund landscape like in Switzerland in the early 2000s? And how did events like the dot-com crash and Madoff scandal shape it?
So I moved to Switzerland in 2004, to Geneva, namely. There were a number of very large wealth managers here. And when you looked at what they did, they were all fully involved in hedge funds. So they were either fully invested in hedge funds, some of them ran portfolios of hedge funds with leverage. There was almost no allocation to long only, because we were coming from, there's a 2000 market crash in technology, and we had the dot-com bubble burst, and then we had uh, basically the 9/11 events. So equities were a different space, more difficult space in the first decade of this millennium. So a lot of money moved to hedge funds. In 2008, namely, that's when we started Lake Geneva Investment Partners. In 2008, at the end of 2008, we had the famous Madoff crisis. The Madoff crisis, well, it was a big deal, especially here in Switzerland, because a lot of wealth managers were invested in Madoff. And what it did was it somewhat broke the confidence of investors back in the day into liquid alternatives or hedge funds, because they felt that it was opaque. Well, Madoff was opaque, and because of that, in the period that ensued, any money that flowed to liquid alternatives typically flowed to the very, very large managers that had billions and billions under management, that gave people comfort that, oh, this is a big name, so it should be okay.
Why did mid-size and smaller hedge fund managers struggle to attract capital post-2000s?
Because they were large institutions. They're very successful funds, by the way. They have terrific track records. They do very well. But because they're large institutions, that institutional comfort was actually pulled capital. And mid-sized and smaller-sized managers actually received very little capital. In fact, I think during that same period, so after the 2008 financial crisis, we had a very large amount of liquidity coming into markets, and that's created a bull market that's actually lasted through today, starting in 2009. I guess the low of equities was back in March of 2009, and from 2009 through now, we're in July 2025. This bull market has persevered, and to a large part, it's due to all the liquidity that was pumped in post global financial
Crisis.
crisis.
Why is it important for investors to include liquid alternatives as a meaningful part of their portfolios, and how can they benefit from doing so?
That actually comes from their non-correlation to traditional assets. If we look at a typical investment cycle, remember we had said if you hold the market forever, you'll do well. But very often what happens is, well, there's a few stages of what happens. First of all, the majority of wealth globally is obtained when markets are typically making new highs. That means the economy is doing well, people are doing well in their businesses, restaurants are full, everything is going well. So that's the point where people have the majority of their liquid capability, investment capability. Unfortunately, that coincides with market highs. So very often when you're coming into money is when the markets are already pricing in very high valuations. On the other end of the cycle, during crisis periods, those periods are when liquidity is very hard to get to. It's when nobody wants to lend. It's when asset prices are low, and even though they're low, not many people are willing to buy those assets. And it's when people lose their jobs. It's when people lose their incomes. So the times when investors typically have the most need for money is at market lows. So this is the problem that comes with the stock market. Now, if you've got very, very big pockets and you can withstand all of that because you don't have any leverage, because you don't have much debt, because you're able to absorb all of those fluctuations,
Survive.
survive them. That's a very good word, Sahhar. Then you'll be able to benefit from those long-term trends, as do great investors like Warren Buffett and such, because they're able to wait when the markets are expensive, and they're able to deploy capital when the markets are in distress because they have a committed capital that doesn't go away from them at the worst time.
What can investors do to avoid making emotionally driven mistakes in their portfolios?
So the one big mistake that we've always made in the investment community, and it's an issue that for some reason is never really addressed, is that investors are human beings, and human beings have certain characteristics, certain traits. We have fears, we have greed, we have fear of missing out, we have the desire to make as much or more than everybody else. These are human emotions and human traits. They are real. So what happens is investors are more comfortable and more likely to invest when equity prices are typically very high, because there's much more confidence, there's much more greed at that moment. And investors are most likely to decide that stocks are not a good place for them when there's a lot of stress in the market, right? When they're suffering. So when you put all of these into one equation, it means that if you can, in your portfolio, if you're able to smooth out your returns, it makes you a more robust investor. It makes you, for lack of a better word, stronger. So basically, the method by which you're able to smooth out the returns of a portfolio, instead of having massive fluctuations, to have smaller fluctuations. Instead of having massive drawdowns, having smaller drawdowns, is basically to find assets that perform well at different times. They have to be assets that perform over time. However, their correlation to each other, if that correlation is low, then you'll be able to make a good return, all the while reducing the volatility of your returns, eventually making you a stronger investor.
What mindset should investors adopt before entering the markets to handle inevitable ups and downs?
It's kind of like if you're entering a boxing ring and hoping not to get punched. If you want to invest, you have to be prepared for fluctuation. Whether it's in liquid alternatives, whether it's in equities, whether it's in bonds, whether it's in whichever investment you make, you have to prepare yourself for the risks of that investment. Otherwise, for lack of a better term, you won't deserve the return that comes from it. To be able to deserve that return, you have to be able to survive the fluctuations that are within it. So it is very important that that we understand the risks that are associated with each asset. Equities are great. Can equities drop 50%, 60%, 70%? They can.
Yeah.
Okay, so when you look at your equity portfolio and you say, okay, this is great. I have so much money in equities. Imagine it down 50%. Are you okay? Are you comfortable? Are you able to survive that?
And how can you prepare for that emotionally and financially?
Prepare for it emotionally. Our financial future is, we can take all the steps that we want to protect our financial future. That there are certain things that just aren't in our hands, right? So there are certain things that investors may not be able to foresee, or you may have, if you have a collapse in the debt of a government, that would have so many repercussions that the survivors would be, you'd be able to count them by hand. It'd be mostly the people that have bought a lot of gold and stuck it under their house. So really, the only thing that you can do is you can prepare for the worst and hope that it never happens.
But that's not realistic.
It's not really realistic because time has kind of showed us that there is always a reset. There is always a cycle to things.
Do we know what's going to happen in markets tomorrow?
A very good friend of ours, actually, one of our investing partners, he had a terrific definition for this. He basically says, do we know what's going to happen in markets tomorrow? We don't know exactly where equities are going to be. We don't know where bonds are going to be. We don't know where gold is going to be. We don't know where the price of assets are going to be. We don't know where where our liquid alternative portfolio is going to perform, how it's going to go. We don't know any of that. So let's say the future is unknown. Now, he says, if I were to invite you all and load you all into a plane and take you on a trip, and we're going to go on a 1 week trip, and I tell you that we're going to go somewhere, but I'm not going to tell you where. I'm not going to tell you whether we're going somewhere hot, somewhere cold, somewhere mountainous, to a desert. You don't know, and you have to pack one bag. How would you pack it, Sahhar?
A little bit of everything.
Right?
Yeah.
To be able to be prepared for everything. Well, that's kind of what your portfolio is supposed to look like. It's supposed to have different elements that protect you in different circumstances. And if you approach it that way, you wouldn't have your full portfolio focused on liquid alternatives like people did in the 2004s, 5s, 6s, and you wouldn't have only 3% liquid alternatives like people do now. You would have the correct levels of allocation to every segment so that you would be prepared.
Thank you, Gunnar. Before we go, we're kicking off a new tradition on the show called Signal or Noise. Here's how it works. I'll read a headline that's been making waves, and our speaker will share whether they believe it's a meaningful market signal or just background noise. But first, a quick disclaimer. Everything shared in this segment is for informational purposes only and does not constitute investment advice. For any financial decisions, please consult with a licensed financial advisor. So the headline reads, Institutional allocations to hedge funds collapsed from 25% to 17% by 2024. Is this decline a clear signal of investor skepticism in the performance of liquid alternative assets, or just a normal shift towards newer asset classes like ETFs?
Well, I guess it comes back to what we discussed before. Right? Yes, it is a shift towards more traditional assets, towards private equity, towards real estate. There's various segments that receive the flows that came out of liquid alternatives. However, we believe this is due to those long-term cycles that we talked about. In a vast bull market for assets, money will gravitate towards that bull market and will reduce its exposure in other areas. So we think this is a temporary phenomenon. The trick is the definition of temporary. Its phenomenon has lasted probably the better part of 15 years. The trend of these assets moving away from liquid alternatives. Maybe we based around here. I don't know what the data is precisely, but we would expect the following 15 years to actually show a reversal of that movement.
And that wraps up for today's episode of Insights Over Coffee. I hope this conversation with Gunnar Turkmen shed some light on the real purpose of hedge funds, the importance of diversification, and how understanding risk is key to surviving, not just riding out market cycles. If you found this discussion valuable, be sure to follow, subscribe, and share it with anyone looking to build a more resilient investment strategy. We'll be back soon with more deep dives into the trends, strategies, and ideas shaping the future of investing. Thank you for joining us, and until next time.